All right, welcome everybody. Thank you for joining our ETF chat. To my right is Steve Hawkins, Chief Executive Officer of Horizons ETFs, Deborah Frame, President and ETF Portfolio Strategist at Frame Global Asset Management, Alfred Lee, Portfolio Manager for ETFs at BMO Global Asset Management, and Patrick McEntyre, Managing Director of Electronic Trading Services at National Bank Financial. So I want to start by talking about fixed income ETFs. That's obviously the focus of today's conference. Saw some interesting data from National Bank sent around just yesterday, actually, that fixed income ETFs have proven to be a hugely popular investment in Canada this year, attracting $4.8 billion in inflows year to date and $652 million in September alone. That's really significant. If you compare that to the equity number for September, it was much smaller, perhaps even actually a small outflow, if I remember correctly. So, fixed income right now in Canada has been attracting a lot of attention, very popular investment. I want to start, Steve, maybe do you want to kick this off? What do you think's behind that interest right now? What's driving that popularity?
There's a lot of different things going on, but fixed income generally, our ETF marketplace, there's been almost 130 ETF launches in the last year and a half. 30% of those are fixed income ETFs. There's still a significant drive in the Canadian marketplace for wanting access to fixed income solutions. The Canadian retail investor has really been sort of ingrained in the traditional mutual funds, and now with ETFs providing sort of more transparency, more access to liquidity, the retail advisor or the retail investor specifically, I think, has more access to fixed income. You go into your Bloomberg or your trading terminal or whatever, even if your direct trading account, and you can buy stock very easy, and you can buy an ETF very easy. And no, it wasn't ever very easy to buy a fixed income instrument because of the lack of transparency, the OTC market, trading where institutions generally only traded before now. There's just, from my perspective, more access to the ability for the end investors to buy fixed income. And I think, I'm very happy that they're using ETFs to do that.
So Deborah, from the perspective of a portfolio manager, what's generating the interest from your clients?
Well, we create models for our clients. We have 4 models with varying degrees of risk. And then we have a model that distributes income to the client. So obviously, because the way we look at risk, which might be a bit different than most in that we look at the likelihood of losing money, we don't get ourselves too concerned with upside deviation. But we do concern ourselves with downside, and using ETFs allows us to very efficiently and with low cost and ease of trade move in and out of markets because we're tactical and global. So our portfolios that we're creating for our clients allow our clients to have access to markets globally, equity as well as fixed income. And so the important thing for our Canadian clients is that they have the very same access as our US clients would, because the models are the same. We just want ETFs that are tax and cost efficient for our Canadian clients. So we want access to markets all around the world. And a lot of the new issuance in fixed income has allowed us to have better access to the rest of the world.
Alfred, why choose ETFs for your fixed income investments as opposed to a mutual fund or some other vehicle? What's the advantage, the upside of that?
Well, I think with Steve's point, I think an ETF offers a lot of advantages, especially when you compare to the underlying fixed income market, for example. I think when you look at the Canadian fixed income market, it's a very opaque market. Down here in the US, at least you have trace, so you know where the last bond traded. In terms of inventory. That's another issue as well, because if I come out and buy a bond, if I'm building a portfolio, if I come back 3 months later and I try to buy the same bond, I may not be able to find that bond. So there's a scalability issue as well. Also, when you look at bid-offer spreads for the ETF compared to, say, the underlying market, especially when you go to the long end, the bid-offer spread could be exceptionally wide. So with an ETF, because that's secondary market liquidity, the bid-offer spread could be much tighter, especially when you look at corporate bonds, but even government bonds as well. Inventory is not an issue because you have a standardized product, and also in terms of visibility, because an ETF trades on an exchange, you know exactly where the bid-offer spread is. You know exactly if there's a bulk order done. You know whether it was done on the bid or offer. So there's a lot more intel compared to not only the underlying fixed income market but also mutual funds as well.
Patrick, from a trading perspective, I think everyone here knows that Canadian fixed income tends to be less liquid, less transparent than in the U.S. So, what from your perspective does the ETF offer?
One of the main things that comes into it is when you have a more mature ETF, whether it's a beta fixed income or an active fixed income, when there is that two-way flow from natural investors inside, that's where you start to get trading that's actually inside the spread. And that's how we find, Alfred will find sometimes that he can get better liquidity from the ETF cheaper because there's that natural two-way flow that's out loud on the board, explicit and displayed. And so that's a true advantage of that structure.
One thing I want to add is that I think in this environment, it's become increasingly important for portfolio managers, whether it's active or asset allocators or whatever it may be, to, in this interest rate environment and where credit is widening and tightening in certain areas, you need to be quickly able to deploy assets in different areas within fixed income as well. I think that's where an ETF offers a lot of advantages because it's liquid and it's highly efficient in terms of recharacterizing your portfolio from a risk and return basis.
And just to add to that is that as a portfolio manager and being tactical, at times when interest rates are moving, we're going to also be trading more frequently. So one of the things about ETFs is that the cost to trade an ETF, it's not just liquidity. The cost to trade it is typically quite a bit less than it would be to trade directly into the marketplace. So that is also a really big factor. And when we're screening for the ETFs that we use, sometimes we come across similar ones, and in that case, cost matters in terms of not just the MER that the ETF has, but how it trades. We look at how liquid it is, how it tends to trade against its NAV, and it is a big factor in the ETF we're going to choose.
So cost, liquidity, speed, many, many advantages there. Alfred, you mentioned interest rates, and Deborah, you too, and just in the context of things are changing relatively quickly after being quite, staid and boring for a long, long time. We had an NAFTA deal yesterday, had to work that in somehow. So that could potentially affect interest rate expectations. So, given the current market environment, the expectation for rising rates, how do you think that's, actually Steve, I'll start with you, how do you think that's going to affect demand for these sorts of products? And I guess what sort of products will people be looking for in that environment?
Well, we've seen a significant amount of flows this year into lower duration, floating rate, preferred shares, which has a significant rate reset portion to it. So there's a lot of sort of interest rate sensitivity built out there into the marketplace. So, and we see active ETFs taking a much larger role over beta generally. So the flows are, I say, pretty comparable between the beta and the alpha, but because we're charging a little bit more for alpha, we're seeing alpha be able to traditionally and continued outperformance over the standard beta. There's a lot of inefficiencies in the fixed income market generally, but just changes in interest rates, changes in Canadian dollars. To Deborah's point, being tactical, it really is the new alpha from my perspective, and people are using beta ETFs or alpha fixed income ETFs in that regard to be able to move around the portfolio based on their views of interest rates, based on their view of the Canadian dollar, what's going on, how that's going to affect your portfolio, whether it's hedged or unhedged. Those are all, there's an ETF for everything now. Canada has over 700 ETFs, which is, I don't want to segue into your next point, but there is an ETF for anything you want really, and there's more and more opportunities for portfolio managers to change their portfolio based on very, very specific views of the fixed income marketplace.
So I'll throw this out to you guys. How important is active management going to be? I mean, we've seen a proliferation of actively managed fixed income ETFs over the last little while. I think there's been quite a few new ones out this year. So, given the interest rate environment, how important is that active management going to be as a strategy?
I think let's just pause for a second though, because we're in the States, and especially down here, the term ETF is usually conflated with passive or beta investing. And in Canada, that's largely different because of a few regulatory rules that are not interesting to get into here. But the upshot is that it's much more friendly towards the liquidity provision in active ETFs. There's a lot more transparency that comes to the market makers. As such, I think it's roughly a quarter of the ETFs in Canada are actually active. and a number of them are sort of somewhere between active and smart beta. So it really is a different landscape in the ETF culture and the ETF offering in Canada than it tends to be down here.
Yeah, it's a very good point. Actually, just on the regulatory side, I won't get into too much into the weeds, but it is an interesting point to note that, and correct me if I'm wrong, but in Canada, it's an issue of disclosure. So in Canada, you only have to disclose your holdings quarterly, I believe.
Yeah,
monthly. Okay. And in the U.S., it's daily, right? So what it allows is for portfolio managers, active ETF managers, to protect their strategies, not be disclosing what they're doing on a day-to-day basis, which of course gives them a bit of an edge. So that's the major difference.
And then one more so is you are, as an asset manager, you are allowed to selectively disclose what's in the fund. So you can tell your market makers, which we kind of insist on, but without having to disclose to everybody. And so that selective disclosure is a real differentiating feature, and it's why we're able to keep tight markets in these active products at the same time as having them be opaque to the rest of the market.
So Alfred and Deborah, from the portfolio manager perspective, are you seeing a lot of demand for actively managed fixed income ETFs right now? Are they more popular in this environment than the passive ones?
Yeah, I would say so. I think what we're seeing now is there's a division in terms of how investors are moving. So there's a lot of investors that are perfectly comfortable with creating their own portfolio. So clients such as Deb that are asset allocators and building their own tactical portfolio. So I think for investors like that, they want kind of more traditional beta products where they're just looking at different ways to get exposure. Do they want high yield? Do they want preferred shares or whatever it may be? But there's also, because of the interest rate environment and because we're a little bit long in the credit cycle as well, a lot of people just want to delegate that fixed income investment to an active manager. So we're definitely seeing that as well. So I think a lot of active ETFs are being launched at the right time, and also they're the right strategies as well. They're not just plain vanilla kind of core Canadian mandates. They kind of go anywhere mandates like core plus strategies or unconstrained strategies.
Yeah, I mean, we see a lot of comfort in the retail advisor network. And I mean, between Alfred and I, we run the largest 2 preferred share ETFs in Canada. His is passive beta, mine is active. But the retail advisors really, it's a very, very complicated market on that side of the fixed income scale. Let's call it preferred shares fixed income. But it takes a lot of work to understand the nuances of every single one of the types of preferred shares that is out there. It's not just the credit risk and the interest rate risk and the yield that's coming out of these portfolios. I mean, there's a lot of analysis that has to go into it. And why not hire a professional manager to do that for you when you could spend more time trying to service your clients in other ways, going out and earning new clients and things like that. So, it's, from my perspective, much easier for a retail advisor to manage an equity portfolio, even for Deb to manage an equity portfolio, or to tactically transition their portfolio from one sector or one commodity to, or one other asset class very, very easily. Whereas on the fixed income side, there's just too much analysis that has to go into the different pieces of the puzzle, and why not hire a professional asset manager to do that for you? And whether it be beta or active, it just takes it's a lot of time constraints otherwise, and we are a solution provider. So that I think ETFs are the single largest disruptive technology from a solution provider perspective.
Deborah, do you agree with that? The issue of complexity?
Yeah, I mean, for what we're trying to do, and what we're offering to our clients, we're creating alpha by our tactical strategies. So it is true that we would be far less likely to use what would be considered an active fixed income ETF. Although, to some degree, all fixed income ETFs are active because, unlike the equity side, you can't mirror an index, right? With any fixed income ETF, you get a collection of underlying fixed income that meets the qualities of the ETF. But because of maturity and things like that, a manager who manages a fixed income ETF is constantly having to trade and rebalance within it. It's a little bit of a different challenge than a manager who's managing an equity ETF. And so we kind of go halfway with our income product. I'd say with our risk models, we're getting access to broad markets, broad asset classes, and we wouldn't be using what would be considered a traditional active ETF on the fixed income side. But because we have a model that has income distribution, we get into more of an active type of fixed income product when we're looking for income. So a dividend product. And it's true that we save ourselves the manpower. We're a relatively small firm because within the dividend product that we'd be, or interest distribution product on the fixed income side that we would be using in the model, the ETF provider's already done what we need in order to determine that it has the right characteristics like correlation to other indexes and things like that, standard deviation. It's all done for us.
So rather than having to hire an analyst who would have to sort of sort through all that, you can just take what's being provided.
Yeah.
I have to work marijuana into this somehow. It seems to be the theme of the day. It is Canada, after all. Steve, your HMMJ, the Horizons
Marijuana Life Sciences
ETF has been hugely popular this year. That's a segue into the concept of thematic ETFs. We've seen a lot of, this is another way that Canada, I think, differs from the US. A lot of thematic ETFs arising over the last year or two, everything from marijuana to cybersecurity to artificial intelligence. There's a whole range of them. But those are all...
My favorite is Make America Great Again, ETF.
What does that invest in?
All Trump-supported businesses.
Not Harley Davidson. But those are all on the equity side of things. So why haven't we seen any thematic fixed income ETFs yet?
And the fixed income market is probably pretty simple from a breakdown perspective because you're either looking at sort of credit risk, interest rate sensitivity, or yield. And really, people only chop up the fixed income market lots of different ways to break those down, but it's not really where you're going for exposure type of things. And I think as the fixed income market continues to mature, especially in Canada, it's still relatively small and very segregated on an overall basis. There will be the opportunity for things like that, but we really just break it down between senior loans and high yield and preferred shares and aggregate bond, and then we can bring in ladders and things like that. But it really is a pretty simple overall marketplace in the Canadian space. The U.S. is absolutely, significantly more saturated with different issues out there. But there's no marijuana companies that are issuing debt right now. They don't have to. They're just, their stock is going up 25 and 50 and 100% every day. It doesn't really matter.
Yeah, that's true.
So they don't need to raise capital. But I don't think we're going to see thematic type ETFs in the fixed income place for a long time because people are looking for returns when they have a social belief, or we saw the Bloomberg guys and all the ESG type of strategies that are out there, ESG and SRI, and people want to understand what their social values are. They're investing in those, or they have a specific belief about a type or sector of the marketplace. So they want to invest in there because they're looking for returns, whether it be short-term or long-term, from that very specific theme or new sector. And you're not going to get those types of returns out of fixed income instruments. You're going to see it out of equities generally, and it's so much easier to break down the equity market on a either North American or global basis into a very, very specific theme, as in, Make America Great Again, or gamer, or weed. The markets are maturing every day. We see more and more equity issues out there, though there are more indices in the world than there are equities right now listed, which is an interesting fact. But equity market can be divvied up very, very easily. Fixed income market can't, and the equity market is going to continue to deliver you returns where you want to see them.
I think it's also a nature of the underlying market as well, right? So if you look at the equity market, I could create a low vol ETF, pretty easily. I could take a look at the TSX or S&P, and I could just screen for those stocks, and I'm not going to run into an issue in terms of supply. I could always find that stock. When you look at the fixed income market, because it's an inventory-based market, so on paper, I could create, a thematic ETF in fixed income that looks at relative value, for example. It's going to look at bonds that are trading cheap relative to its peer group or whatever it may be. So it's going to provide you with exposure to beta and also this thin layer of alpha generation potential as well. The problem is that when I come down to execute that portfolio or try to make it into reality, a lot of those bonds I won't be able to find. So it's an inventory-based market. Also, my pricing model may be different in terms of what I could actually execute at. So because of that, I think just the nature of the underlying market makes it a little bit more challenging in terms of the fixed income market.
Yeah, to Deborah's point, even the beta version of the fixed income ETF marketplace right now is really active. Stratified sampling is used in every single fixed income ETF out there because you cannot get access to all of the different issuers in those indices. So, and I don't think that is going to change at any point in time soon. I'm not sure why there is beta fixed income ETFs out there because everything is actively managed. It's just managed in a way to meet the objective of that specific index or ETF.
Right.
But one of the great things about exchange-traded funds, and this is the case with equity and bonds, but it matters a lot more with fixed income, is price discovery. That often, because it is a sampling of bonds, and sometimes those bonds aren't trading every single day, there is the ability of the market maker to do analysis and determine what the fair price is. And sometimes because the ETF is trading every day but the underlying isn't, that actually is giving you a more accurate representation of what it's really worth versus buying the individual fixed income instruments in the market.
I think it's very interesting in the US that even with fixed income ETFs listed on the NYSE or NASDAQ or whatever, there has to be an ILPV listed, which produces a price and an indicative NAV of the ETF every 15 seconds. Is the fixed income market priced transparently every 15 seconds so that really means something? Absolutely not. And potentially bringing it to Canada where it's a significantly more opaque marketplace, it just doesn't make any sense at all. Like, I don't understand indicative NAVs, but Patrick's group, and most of the other market makers out there, they do a fantastic job of providing liquidity to the marketplace for high frequency traders, for block trades, for Deborah's groups, and we rely upon the market makers really to make a positive market. And the larger the ETFs, unfortunately, there is that natural two-way flow that Patrick was talking about, and it really does provide efficiency from a transparency, liquidity perspective to the overall purchasers and sellers that are in the marketplace.
But yeah, so most ETFs don't have that natural two-way flow. So in many cases, it's more like it's sitting on a pharmacist's shelf, and you go and you buy it from us, and we sell it to you out of inventory. But on those large creates, what we do find is because the creation baskets, which I'll assume everybody knows what those look like, because those creation baskets in fixed income aren't the entire portfolio, there is a limit to how much we can create in a day. So that the mechanism that comes out of those large trades is a very active discussion between the portfolio manager and the market maker about what a suitable portfolio to submit is. And that's how these things, even outside of rebalance dates, become very active funds, because anytime there's a large inflow or outflow, there's an ongoing, open, rather quick discussion between the portfolio management and the market maker about what's coming in and what's going out. And it gives them a lot of latitude to run that fund as they see fit.
So I wanted to ask, Steve, you mentioned at the beginning that, would you say 700 products now in the Canadian?
Over 700
Over
ETFs,
700 ETFs in the Canadian market. That's a huge number. If you look at it proportionately to the United States, it's much higher per capita. And there's been a lot of new providers and new products coming out over the last 12 months or so, record numbers. So you may have different perspectives on this, but I'll throw this out to all of you. Is the Canadian ETF market oversaturated?
Let me start by just, the thing about the 700 number is that there are so many currency hedge versions and partially currency hedge versions in Canada that we don't have in the States. So by and large, US ETFs are not currency hedged. I think Wisdom Tree has a few, but by and large, they're not currency hedged. And in Canada, almost every ETF that has any kind of international exposure will have one flavor that's currency hedged and one flavor that's not. So you have an almost immediate doubling of the number of products in the market. It's not really double, it's probably an extra 150.
It's only 150.
About 150. But it really does juice that overall number. So when we think of how many issues are out there, we think more around the number of 600, which is a little more palatable. But definitely, I mean, the sheer number of S&P 500 ETFs that is in Canada is like 7.
We don't need another one.
Right? We don't.
But even with all that, I do think there's an oversaturation. I think, a lot of different ETF providers have come to the market where they want to just do ETFs, and I think it's going to be really, really challenging because a lot of that, a lot of the low-hanging fruit and a lot of that innovative space is already taken. We've seen a few ETF providers come take a different approach where they have a pre-existing fund in a mutual fund space or investment boutique that has a very interesting strategy that they just want to launch as an ETF series. So it's just a different series of a pre-existing fund. I think that's a better way to approach it at this point. But even with some of the Canadian banks, so some of the other Canadian banks trying to launch ETFs, they kind of have like, 1 foot in, 1 foot out, and they're not really dedicated to the business. And as Steve could probably attest to, I mean, being an ETF provider, you need to be fully into the business. It has to be 110% of your business, fully allocating your resources. It's not something you run off the side of your desk.
I mean, there's 2,100, just over 2,100 ETFs in the US. I mean, and we have 600 ETFs, different types of ETFs in Canada. And we're less than 1/10 the size of the American marketplace from an asset management, investable people perspective. It's not sustainable, absolutely. There's going to be continued consolidation, even though not all of, Fidelity just announced in Canada, so that was the last of the largest asset management companies that had not joined the ETF space. The National Bank doesn't have any of their own, but they're not going to. They're an outsourcer, which is great for them. But there will have to be some consolidation at the end of the day. There's only $50 billion ETFs in Canada, less than that. And it's not going to dominate the marketplace, but this is a sales hand-to-hand combat industry from my perspective, especially on the fixed income side of things. When we send our fixed income portfolio managers into meetings and they get to talk interest rates and they get to talk about yield curve and things like that, we make sales. But it's not. This is not the BlackRock model anymore, where it was just they had the most active, cheapest fixed income ETFs out there, and they don't anymore. There's BMO's significant competition, Vanguard's significant competition. I do it a little bit different from everybody else, so we've gone down the active route where they're all low cost beta and race to the zero kind of thing. I'm always going to charge more. I don't understand why Deborah won't pay 10 basis points more for 100 basis points about performance, but that's her decision at the end of the day. But this is a race to zero marketplace, especially on the fixed income side. It's cheaper and easier to run the portfolios, and there will have to be some changes out there. There will be consolidation. ETFs just keep closing. I mean, but we're taking over the mutual fund markets. Mutual funds are dead from my perspective. No offense to the mutual fund producers out there, but we're going to see. Fixed income ETFs are the way of the future.
Deborah, last word to you. Is having all that choice a good thing? Maybe you don't need 7 S&P 500 index ETFs, but
I think our firm probably even only analyzes about 10% of the ETFs in Canada to consider. But our focus is very specific on how an ETF mimics an asset class, and we look at correlations. So we're much more narrow in how we would use them than a lot of other managers would. I think for a portfolio manager who is focusing on adding alpha through asset allocation, there's going to be fewer ETFs for that kind of a manager.
Mm-hmm. And is the race to zero a good thing?
No, it's for what we want, I don't think it's possible to pay zero. And I think that zero is very misleading. We could get into a long talk about that, because I think with zero you just get wider NAVs, and somebody's getting paid.
Patrick will get paid.
Someone's getting paid, and it comes out of the trade rather than out of the MER.
Right.
It's just the way it is.
Well, unfortunately, we're out of time, so we can't get into a long discussion about the race to zero. But thank you, everyone, for joining us.